Welcome to our YouTube channel. Have you ever felt that rush of excitement when your earnings start rolling in? It's an incredible feeling, isn't it? Suddenly, your shopping list grows, dream vacation spots fill your search history, and there's a slew of important additions. But amidst this whirlwind, the thought of savings sneaks in. Earning is just the first step. Knowing how to wisely invest and utilize those earnings is equally crucial. In today's video, we're diving into the world of personal finance. We all encounter various pieces of advice on managing our money, some of which we might have blindly followed. But not every piece of advice out there is practical or beneficial. Join us as we debunk some of the most common personal finance myths that desperately need to be busted. Let's separate fact from fiction and set you on the path to financial clarity and success. Don't forget to like, subscribe, and hit the notification bell so you never miss out on our myth-busting finance tips. Number 1. More money equals more happiness. The connection between money and happiness isn't as straightforward as many believe. While there is a correlation between higher income and overall happiness, it's not an absolute equation. Research indicates that even millionaires might not experience extreme happiness. Money doesn't shield individuals from life's challenges like health issues, relationship concerns, environmental worries, or broader societal issues. Moreover, having substantial wealth often brings a different set of pressures, societal expectations, and an array of shoulds that can drain financial resources. These expectations may include maintaining multiple properties, frequent travel, and other expenses that could erode wealth. Life, regardless of income, is a blend of ups and downs. What seems to foster a sense of control and contentment is understanding how to allocate resources wisely to cover necessities, desires, and future goals. Managing finances effectively can provide a sense of financial control, ultimately leading to peace of mind and a degree of happiness. It's not just about the amount of money one earns, but rather the ability to make informed decisions about how to use those funds to secure one's needs, fulfill desires, and plan for the future. This sense of financial control and the ability to align spending with personal values and goals often contribute significantly to overall happiness and contentment in life. Number 2. Delay retirement savings until later. The belief that retirement saving can be delayed, especially when you're young, is a myth that could significantly impact your financial future. Time is indeed a powerful factor when it comes to investing. Consider this scenario. A 25-year-old investing $200 a month at a 6% return could potentially amass $393,700 by age 65, thanks to the magic of compounding interest. Now, if the same individual starts saving at age 35, they'd only accumulate around $201,100, about half of what they'd have if they started a decade earlier. Though retirement might seem distant when you're young, starting to save early offers a massive advantage due to the longer time for invested money to grow. One way to kickstart retirement savings is by taking advantage of employer-provided plans like a 401(k). If your workplace doesn't offer such a plan, opening an individual retirement account, IRA, or a Roth IRA is another great option. These accounts provide tax advantages and can serve as effective tools to secure your financial future. The key takeaway: don't underestimate the power of starting early when it comes to saving for retirement. Time is your ally in building a substantial nest egg, so the sooner you begin, the more you're likely to have when that retirement day arrives. Number 3. Credit cards lead to debt. Using credit cards responsibly doesn't automatically lead to debt. It's when your spending exceeds what you can comfortably pay off that the potential for debt arises. Wisely managing your credit card by consistently paying off the balance each month can actually boost your credit score. A responsible approach to credit card usage involves timely bill payments and judicious spending habits. Regularly paying off your credit card bill demonstrates financial discipline and positively impacts your credit score. However, impulsive spending without prompt bill payments can adversely affect your credit score, leading to financial complications. That's why it's crucial to monitor your purchases, maintain control over spending, and ensure timely payments of your credit card bills. Managing your credit card in a disciplined manner not only prevents accumulating debt, but also contributes positively to building and maintaining a healthy credit score. Number 4, no need to budget with enough money. Creating and sticking to a budget is essential, regardless of your income level. It serves as a foundational tool for organizing your finances and achieving stability. Budgeting, especially for beginners, plays a crucial role in managing spending, debt, and savings for future goals. Even if you're debt-free, a budget remains a vital tool for effectively managing your money and directing funds toward both short-term necessities and long-term aspirations. There's a range of techniques and tools available for budgeting, from spreadsheets and journals to various mobile apps. One popular strategy is the 50-30-20 budget rule, which allocates 50% of your post-tax income toward essential expenses like housing, food, and utilities, 30% for discretionary spending wants, and 20% for debt payments and savings. Adopting a budgeting approach that suits your lifestyle and financial goals can provide a clearer understanding of where your money goes, empower you to prioritize spending, and guide you toward a more secure financial future. Number 5, money solves all problems. The relationship between money and well-being isn't solely defined by the amount you earn. While money can handle bills and provide a level of comfort, the old saying, "More money, more problems," does hold some truth. The crux of financial security lies not in how much you earn, but in how effectively you manage your money. Consider this scenario. You land a higher-paying job, doubling your salary. But if you immediately upgrade to a more expensive lifestyle, a pricier house, car, and indulgent vacations, you might end up in more debt and experience heightened stress levels compared to before. The key to avoiding such pitfalls is living within your means. Prioritizing healthy budgeting and saving habits is crucial in preventing financial strain. Rather than letting an increase in income lead to escalated spending, prudent financial management involves maintaining a balance between your income and expenditures. This approach allows for the creation of a safety net, providing stability and peace of mind irrespective of income fluctuations. Ultimately, it's not about the amount of money you earn, but how well you manage and allocate those funds that determines your financial security and overall well-being. Number 6, 3 months of emergency savings is a must. Having an emergency savings fund is a crucial safety net for unexpected situations like job loss or unforeseen medical expenses. The recommended amount, ideally 3 to 6 months worth of living expenses, serves as a cushion during challenging times. However, it's a reality that many individuals struggle to save even 1 month's expenses. In fact, nearly half of Americans find it challenging to cover a $400 surprise bill. If you're in this group feeling overwhelmed by the prospect of creating an emergency fund, it's essential to address financial anxiety and take small steps towards building that safety net. Starting small is key. Even saving a modest amount, like $25 per week or month, can lay the groundwork for your emergency fund. Consistently allocating these small amounts over time can accumulate into a significant rainy day fund. The key here is consistency. By setting achievable savings goals and steadily contributing to your emergency fund, you'll gradually build up savings, providing a level of financial security against unexpected expenses. Remember, every little bit saved brings you closer to a more stable financial future. Number 7, money buys relationships. The belief that more money could fix personal life challenges is a common misconception. True friendships and genuine relationships aren't based on financial status. They're rooted in the value of the individual. If you find yourself leaning towards the notion that money could resolve relationship issues, it's essential to challenge that belief. Building strong relationships isn't about financial wealth. It's about investing time, effort, and care into personal connections. Enhancing personal networks, nurturing communication skills, and investing in meaningful interactions are crucial steps toward improving relationships. Money might provide temporary comfort, but it's the depth of emotional connections, trust, and understanding that truly solidify relationships. Fostering these deeper connections and working on interpersonal skills can significantly enhance the quality of your relationships, offering more profound and lasting satisfaction than any financial gain ever could. Number 8. Wealth equals extravagance. The media, particularly reality TV and luxury influencers on social platforms, often portray an image that equates wealth with lavish and extravagant living. However, the truth is quite different for many wealthy individuals. Contrary to popular belief, not all rich people reside in mansions or drive fleets of expensive cars like Bentleys. In reality, many millionaires live modestly and are mindful of their spending habits. They understand that excessive spending can hinder wealth accumulation. The core philosophy here is that the more one spends, the harder it becomes to build and maintain wealth. Many financially successful individuals prioritize frugality and prudence in their lifestyle choices. They focus on saving, investing wisely, and managing their finances sensibly rather than indulging in extravagant purchases. The portrayal of opulent lifestyles in media doesn't reflect the financial principles adopted by many millionaires. Instead, a modest and financially prudent lifestyle often plays a significant role in their ability to accumulate and preserve wealth over time. Number 9. Money alone equals security. The amount of money you have doesn't solely determine financial security. True security stems from prudent saving and wise investing habits rather than the sheer size of your bank account. Consider this scenario. Winning the lottery might bring a massive windfall, but if it's spent impulsively on luxurious indulgences like extravagant travel, it doesn't guarantee financial security. On the other hand, someone with a modest income who consistently saves and invests in their employer's 401k plan, especially leveraging company matches, might actually have a more secure financial footing. This highlights the importance of having a financial plan and making mindful decisions about money. Establishing a plan and consistently saving and investing in the right avenues are key components of achieving financial security. It's not just about how much money you have, but how wisely you manage and grow it that ultimately determines your financial stability and security. Number 10. Money opens doors to social circles. Expanding your social network and engaging in fulfilling activities doesn't have to come with a hefty price tag. While having more money might open doors to certain experiences, there are plenty of ways to connect with others and explore new interests without breaking the bank. Joining private clubs or attending high-cost events aren't the only avenues to meet new people and broaden your social circle. Volunteering presents a fantastic opportunity to engage with like-minded individuals and contribute positively to causes you care about without spending money. Donating your time and energy to local nonprofits, museums, community organizations, or charitable causes allows you to connect with people who share similar values and interests. These experiences can be immensely rewarding and serve as platforms for meeting new friends or building connections within your community, all without a financial commitment. In essence, fostering meaningful social connections and exploring diverse interests can be achieved through various cost-free or low-cost avenues like volunteering, It's a valuable way to expand your social network and engage in fulfilling activities without relying on a hefty budget. Number 11. Only the rich can travel. Traveling isn't exclusive to the wealthy. It's accessible to individuals across different income levels. The key to embarking on a vacation lies in effective budgeting and planning. Initiating a dedicated vacation fund, a separate account specifically designated for travel savings, is an excellent way to start setting aside money for trips. This systematic saving approach allows individuals to allocate a portion of their income toward travel expenses. Moreover, there are numerous strategies to make travel more affordable. Platforms like Airbnb, VRBO, and other rental services often offer accommodations at lower costs compared to traditional hotel rooms. Additionally, various credit cards provide travel-related perks such as frequent flyer miles or discounts on lodging when used, making travel more affordable and rewarding. By utilizing these cost-saving options and being mindful of budgeting, individuals at any income level can plan and enjoy vacations without straining their finances. With careful planning and leveraging available resources, traveling becomes an achievable and enriching experience for everyone, irrespective of their financial situation. Number 12. It's normal to have a lot of debt. Not all debt is created equal. There's a distinction between good debt and bad debt, and understanding this difference is crucial in managing one's finances wisely. Good debt, such as a mortgage, tends to have lower interest rates and can potentially contribute positively to your financial well-being. For instance, a mortgage is often considered good debt as it helps build equity in a property and can enhance your credit report if managed responsibly. This form of debt allows individuals to invest in an asset that typically appreciates over time. Conversely, bad debt involves higher interest rates, like those seen with credit card debt. With interest rates hovering around 20%, credit card debt doesn't contribute to wealth building and doesn't generate any equity. Instead, it often leads to a cycle of monthly payments that could otherwise be channeled towards savings or investments. While it's common for many households to have some form of consumer debt, particularly credit card debt, it's essential to avoid accumulating high-interest debt whenever possible. Financial experts widely recommend steering clear of bad debt due to its potential to accumulate rapidly and hinder your ability to save or invest for the future. Number 13. I should avoid talking about my money problems with others. Discussing money matters should not be taboo. In fact, it can be incredibly beneficial to open up about financial concerns to close family and friends. Often, these individuals might have faced similar situations and can offer valuable advice or solutions based on their own experiences. They can provide support, different perspectives, and possibly helpful strategies to overcome financial challenges. However, if discussing money troubles with family or friends feels uncomfortable or isn't an option, seeking guidance from professionals is a great alternative. Nonprofit credit counseling organizations like the National Foundation for Credit Counseling, NFCC, offer invaluable assistance, especially for those feeling overwhelmed by debt. These organizations have trained professionals who can provide guidance on debt management, budgeting, and financial planning. They offer tailored advice and strategies to help individuals regain control of their finances and work towards a more stable financial future. Remember, seeking help when facing financial difficulties is a proactive step toward finding solutions and alleviating the stress associated with money troubles. Whether through personal networks or professional organizations, support and guidance are available to navigate challenging financial situations. Number 14. It's better to buy a house rather than rent. The decision between renting and buying a home is a significant one and should align with your unique circumstances and aspirations. While owning a home is often viewed as the American dream, renting can offer valuable flexibility, especially for individuals who aren't ready or inclined to buy a home. Renting allows for mobility, which can be essential for those who frequently relocate due to work or are waiting for specific life milestones like choosing the right school district for their children. Moreover, renting alleviates the financial responsibilities associated with homeownership, such as mortgage payments, property taxes, and maintenance costs. Some individuals prefer to avoid these expenses and the commitment that comes with owning a home. The key takeaway here is that the decision to rent or buy should be based on what aligns best with your current situation and future goals. It's essential not to succumb to societal pressure or preconceived notions that homeownership is the only path to financial success. Both renting and buying have their merits, and the right choice ultimately depends on your individual preferences, lifestyle, and long-term plans. Number 15. I need to be rich in order to invest. Investing isn't exclusive to the wealthy. Anyone can start investing, even with small amounts of money. It's a common myth that you need a substantial sum to begin, but in reality, you can start with as little as $10. Moreover, having debt shouldn't necessarily deter you from investing. Investing, despite its risks, is often a pathway to building wealth. Over time, it has the potential to yield healthy returns. For instance, the Standard & Poor's S&P 500 had an annualized 10-year return of 15.43% at the start of 2022, showcasing the potential growth available through investing in the market. Today's accessibility to investing through robo-advisors and investing apps has made it convenient for individuals to start investing without requiring extensive market knowledge. These platforms offer user-friendly interfaces and diversified investment options. For those who prefer guidance, working with a human advisor is also an option. However, it's crucial to research and understand any fees associated with investing to be fully prepared for the costs involved. Ultimately, whether you choose automated platforms or prefer human guidance, investing has become more accessible than ever, allowing individuals to start building their wealth irrespective of their financial status or expertise in the market. Number 16. High salary equals wealthy. Absolutely. Earning a high salary doesn't automatically equate to being wealthy. Wealth is more about how effectively you manage and grow the money you earn rather than the amount of income you bring in. The key to accumulating wealth lies in a mindset focused on preserving and growing money. Saving and investing wisely are crucial components of building wealth over time. Wealthy individuals often prioritize these practices to secure their financial future. To illustrate, consider two individuals, one earning $50,000 annually, living within their means, and diligently saving and investing, while the other earns $500,000 but spends excessively on multiple properties and luxuries without a focus on savings. Surprisingly, the person with the lower income could potentially be wealthier due to their prudent financial habits and effective management of their resources. Ultimately, wealth is about the accumulation of assets and financial security achieved through responsible financial habits rather than solely relying on a high income. It's the mindset of managing and growing money wisely that leads to true wealth and long-term financial stability. Number 17. I can't improve my finances unless I work with a professional. While working with a financial professional can offer valuable guidance, managing your finances well doesn't necessarily require their assistance. The choice to seek professional help is entirely up to you. Improving your financial situation can start with educating yourself through various resources. Reading about cash management tactics, tuning into financial podcasts, or exploring apps designed to assist with budgeting and tracking spending can be highly beneficial. Many banks also offer these tools to their customers, making them easily accessible. Moreover, Online calculators are valuable tools for assessing various financial decisions, such as refinancing student loans or mortgages. They provide insights into potential outcomes and help in making informed money moves. The availability of these resources empowers individuals to take charge of their finances, allowing them to better manage their money, track spending, and make informed financial decisions without necessarily relying on a financial professional. Ultimately, it's about finding the right tools and resources that align with your financial goals and preferences. Number 18. I need to work until 65 in order to retire. Retirement age isn't a fixed number applicable to everyone. It varies based on individual circumstances and financial preparedness. While 65 is often considered the typical retirement age, the decision to retire earlier or later depends on several factors, particularly financial readiness to cover future expenses. Today, many individuals opt to continue working beyond the age of 65 for various reasons. Delaying retirement can have financial benefits, such as increased Social Security benefits if one postpones tapping into them until age 70. Additionally, staying engaged in work or pursuing part-time employment allows for continued income streams and the ability to bolster retirement savings. The age at which one chooses to retire is deeply personal and influenced by financial stability, health considerations, and individual goals. It's essential to assess one's financial readiness and evaluate factors like savings, investments, and anticipated expenses before making the decision to retire. Ultimately, there isn't a universal retirement age. Rather, it's a decision contingent upon individual circumstances and future financial needs. Number 19. Must have huge savings to start investing. The idea that investing requires a sizable chunk of money up front often holds many people back from taking that crucial first step. It's common to set a savings goal thinking, once I reach this amount, then I'll start investing. However, the reality might surprise you. Here's the catch. You might struggle to reach that targeted X amount if you don't begin investing in the first place. One prevalent misconception is that investing demands a significant initial capital, which isn't necessarily true. Contrary to popular belief, you don't need a huge sum to start investing. Enter systematic investment plans, SIPs, in mutual funds, a game changer for budding investors. With SIPs, you can kickstart your investment journey with as little as $10 per month. Yes, just $10. The beauty of SIPs lies in the power of compounding. By investing regularly, even with a modest sum, you're allowing your money to grow over time. This compounding effect turbocharges your investments, potentially helping you achieve your financial goals sooner than anticipated. The advancements in technology and finance have significantly widened the avenues for beginners. You're no longer limited by a lack of capital or extensive financial knowledge. With SIPs and various other user-friendly investment options available today, diving into the world of investing has become more accessible than ever. So, whether you're just starting out or contemplating taking that first step into investing, remember, it's not about the amount you start with. It's about starting early and staying consistent. Embrace the power of SIPs and compounding to pave the way towards your financial aspirations. Number 20. You should not invest in life insurance because it does not generate adequate returns. There's a common misconception that life insurance, especially those bundled with investment features, serves as a one-stop solution for financial goals like education, retirement, or a child's marriage. However, these investment-cum insurance plans might not quite deliver what they promise. While these plans are often promoted as a way to invest and secure life insurance simultaneously, they might not offer returns that beat inflation nor provide adequate life coverage. In recent times, awareness about alternative investment avenues, particularly equity mutual funds, has been on the rise. Many investors are attracted to these funds due to the potential for higher returns, leading them to reconsider traditional life insurance as a primary investment choice. It's crucial to recognize that investment-cum insurance plans might not be the best approach for achieving financial goals. Investing in carefully selected equity mutual funds can indeed help grow your wealth, but they don't offer life insurance coverage. Hence, the suggestion is to view insurance and investments as separate entities. Alongside your investment portfolio, it's advisable to secure a sufficient term life insurance cover. This ensures that, in the unfortunate event of your passing, your family's financial needs are taken care of. In essence, while equity mutual funds might assist in reaching your investment objectives, they don't substitute the critical role of life insurance. By acquiring a term life insurance policy in addition to your investment strategy, you create a comprehensive financial plan that safeguards your family's future. Number 21. You do not need to buy life insurance if you are young and healthy. Life insurance isn't something you buy at the moment you need it. Rather, it's a proactive step best taken while you're young and in good health. This timing allows you to secure maximum coverage at an affordable premium. Contrary to popular belief, life insurance isn't solely for individuals with families. Even if you're single, there might be outstanding loans like education loans, personal loans, or car loans that could become a financial burden on your parents in the event of an unforeseen circumstance. Moreover, unforeseen health issues or disabilities can disrupt your ability to work temporarily or permanently, resulting in a loss of income. In such challenging situations, having adequate life insurance coverage can serve as a vital financial safeguard for your family's well-being. By obtaining life insurance early, you're not just thinking about potential family responsibilities. You're also securing your own financial stability. It's a proactive measure to protect against unexpected events that could otherwise burden your loved ones or jeopardize your own financial security. Starting early and being prepared for life's uncertainties is a prudent step toward ensuring peace of mind for yourself and your family. Avoiding misconceptions about money is crucial for effectively managing your finances. By steering clear of these myths, you empower yourself to take control of your financial situation. Making informed decisions about budgeting, saving, and investing allows you to optimize your finances, grow your wealth, and work towards achieving your goals. Additionally, these prudent financial moves contribute to enhancing your peace of mind by securing your financial future. Ultimately, overcoming money myths enables you to make well-informed financial choices, ensuring that your money works for you and aligns with your long-term aspirations. Taking proactive steps toward financial stability and wise money management leads to not just wealth growth, but also a sense of financial security and tranquility. Which financial myth surprised you the most or had the biggest impact on how you view money? Share your thoughts in the comments below. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching, and Lil see you in my next video.